then why would you join there? Because your upside is so limited. Your personal equity is going to grow quicker. So keep growing alone until you get to a size where you're big enough that one of these firms might buy you and you're ready to retire. And that's why, again, we're so believing in the emerging firms, the platform firms that are 5 billion, 8 billion, that can become $30 billion firms, because that's where all the value is created and it attracts a younger advisor.
Welcome to Rise Up with Rise Growth Partners, the podcast created to inspire wealth advisors and elevate firms, one transformative idea at a time. Joe Duran and the Rise team share hard-won lessons from building top wealth management firms, showing you what it takes to create a lighthouse brand that inspires clients, attracts talent, and fuels growth. Together, we'll look at where the industry is headed so you can stay ahead of the curve. We're here to be the coach we wish we had along our journey. Let's dive in.
Welcome to Rise Up. Good to see you, Joe. Back again.
Good to see you, Jennifer. Nice to have the spring well in effect, almost summer. And,
yes, it's finally
nice weather
here.
all over the country.
Finally here on the East Coast. So we've talked about mega firms before, but today we're going to go a little deeper. You've written, you have a new article on the topic, and you talk about some of the costs that come with scale. But first, let's take a step back. And I thought it was interesting. We started looking at, even a decade ago, there were so few firms over 20 billion.
Yeah.
And now we have all these mega firms well over 100 billion.
Yeah.
What do you attribute that to?
Well, it's obviously a flow of money. There was a demand, obviously lots of advisors looking for a home, and massive private equity inflows. You know, I think when we sold United Cap to Goldman, it kind of reset the market and gave a different exit multiple for all of the PE firms. You know, when we were first raising capital, believe it or not, we were doing acquisitions of 5 or 6 times, not just us, but Focus and everyone else. Yeah. Maybe they'd go to 8 when you were at Focus and Ecology Group.
I remember when 7, 8 seemed so high.
And the reason is because the private equity firms at the exit would not use more than an 8 times exit multiple, because they didn't differentiate between an asset management firm and a wealth management firm. Asset management firm being a firm that manages money and really is a solution set, versus a wealth management firm, which is a distribution company. It owns the end client in its entirety. And therefore, it's more of a platform that allows you to, like a Netflix, offer other servicing. And so when we sold, it completely changed people's views about what an RIA, a wealth management firm, was worth. And it went from 8 times to 20-something times as an exit multiple. And that made it, so if you add leverage and you're buying things even at 10 times, there's accretion there. And obviously, a lot of money. In the 4 years I was at Goldman, the whole industry really changed and became these very large institutions now, which, as you know, as I wrote, I think are fundamentally changing the landscape. When we started, the few of us who started early on in this voyage, it was really about building a different way of serving clients. And now I would suggest the vast majority of mega firms look very much like the big wirehouses, almost identical.
Yeah,
they're basically recruiting advisors, bringing them in, central execution, much more bureaucracy, but still the ability to be semi-autonomous. It feels just like the wirehouse model, except for one thing: they don't have products to sell; they have services to sell. But and then, you know, is there a big difference between one of these big mega firms and a Merrill Lynch? Not really. They're both fiduciaries. They both operate at, you know, something like a 1% fee, offering financial planning, offering investments. The wirehouses also offer, obviously, all kinds of banking services. But having just left a big global bank, I can just tell you there was not a lot of difference between the advisors at ACO and what we're doing for clients there than what is happening in the independent RIA. In fact, we're probably offering more complete set of services because we could do all the banking side of the house as well. And so the worlds are converging for sure.
Yes. And you go deeper on, you talk about 4 costs to this scale.
I call them, look, it's a double-edged sword. If you grow primarily through acquisition or advisor recruiting, it comes at a price. And there are these trade-offs you have. And I know from building United Capital, we decided to take the opposite path that you took at Focus. You were an investor in entrepreneurs, and Rudy Adolph was very vocal. You can't take an entrepreneur and put them in as
turn
part
them
of
into an employee.
Yeah. And we were very different. I'm like, no, we're not a collection of pirates. We're the Navy. We're one brand. We're one culture. We're one platform. People seem to ignore the reason we got the valuation we did is because it was a truly integrated client experience. All the investments were done centrally. All of the branding was done centrally. All the lead gen was done centrally. And most importantly, the advisors were partners who had equity in the enterprise as we grew it in value. Now, here's the double-edged sword. First, there's a trade-off that every firm has to make if you're a big mega firm around flexibility or fragmented, like are you integrated or not? And that challenge is a big question, because what you do is if you are willing to grow at any cost, you allow the advisors to continue to do what they did in the past with some back office integration. If that happens, that means that the underlying advisors have no loyalty or tie-in, and the clients have no meaningful change to their financial lives because they've joined this mega firm. It's just a change of equity currency. That's very appealing to an advisor who wants to keep doing kind of what they're doing, get a big check up front, but the underlying equity value assumes that somebody who comes in doesn't care about you delivering a unified experience. And I would share with a lot of these mega firms, we do a lot of research, the client experience is very determined by which door you walk in. So, and that's true at a big wirehouse too. If you go to Merrill Lynch, you walk into one team, you're going to get one experience. You walk into another team, get a different experience, all under the Merrill Lynch umbrella. And I would say a lot of these mega firms are being built the same way. We have one name. We don't really have one culture, and we certainly don't have, we have one platform, but everyone's delivering a slightly tweaked experience. And that means that there is no consistency in brand. So it can be very flexible for the advisor, but also doesn't lock in the clients, doesn't give a meaningful accretion to the value of the underlying business. And we would tell the advisors, when you're joining because we're going to make you more valuable, because we're going to improve the way you work, and we're going to improve the lives of your clients. And if those three things are not true, you shouldn't join, because otherwise it's just a financial transaction. And unfortunately, with all the private equity money that's come in, and I don't know if it's fortunate or unfortunate, the reality is it's leading a lot of acquisition activity where I think you have some bad habits. There is no value add to the underlying advisory firm that's joining. It is simply a financial transaction. And that means the client experiences are better.
To one of your second point, another cost you outlined, which was we're talking a lot about equity, but what about the G2, G3 advisor?
Look, this is a massive issue happening right now. We've all been at this now for long enough. It's still a young industry, but there's been acquisitions now for 20 years or so. What does that really mean? It means that the G1, the people who built the business, got a nice check. Maybe they got some equity, but they have stopped working, or they're working less. They've brought in Generation 2 advisors, and those advisors have very little incentive. And while we want them to think like employees, a lot of them actually think like entrepreneurs. And they're sitting there saying, excuse me, what's in it for me? Like, I'm now servicing your 300 clients, generating 2.5 or 3 million in revenue, and I'm getting paid $600,000. And we're starting to see this now, where they're leaving, taking clients with them. They're not beholden to the same restrictive covenants. Not as sticky because they didn't get equity in the transaction. And I think what you're going to start seeing is
they're well-trained, they're in demand.
And most importantly, the clients are loyal to the advisor, because there is no true central experience. And so what ends up happening? You end up having down the road, and I think we're in the early stages of this, then it starts to feel just like a wirehouse. One person leaves from one national RIA, goes to another RIA, and they get recruited over, and they bring their clients over, and there's not a lot of, you can't do a non-compete, you can't do a non-solicit necessarily, because those people maybe have nothing that stops them from leaving because they have no equity. There is no claw on the clawback. So the truth is, that creates a serious challenge. It also means, by the way, that you end up with a model that recruits, that acquires advisors who are ready to retire. Because why would an advisor in the early 30s or late 30s, early 40s, who's built a material business, trade their equity for the equity of an enterprise that's got hundreds of billions? What's the upside? And just like we've seen in the wirehouses, the growth of Merrill Lynch stock is very linked to the market, but they're trading advisors with UBS, JP Morgan, and whoever else. They're going back and forth. The underlying business is fine. It's a good business.
And they don't get meaningful equity.
They don't get meaningful equity because they just take cash. They're like, hey, and by the way, the private equity investors in these mega firms would rather pay cash too, because then they get the accretion and add leverage. So it gives them an equity return booster. But the problem is that the advisors joining have no equity alignment. And if they do, it's a small amount. And if you're a rising advisor, then why would you join there? Because your upside is so limited. Your personal equity is going to grow quicker. So keep growing alone until you get to a size where you're big enough that one of these firms might buy you and you're ready to retire. And that's why, again, we're so believing in the emerging firms, the platform firms that are $5 billion, $8 billion, that can become $30 billion firms, because that's where all the value is created. And it attracts a younger advisor who knows, hey, I'm kind of growing at this rate, but if I can join early and be a voice in building the next platform, then guess what? I'm going to end up participating in the equity. It was true for the folks who joined us at United Capital. Average advisor was 44 years old. Now that meant that they were young, they had young clients, they were growing. Right. And that leads to the third thing. There's an organic growth deficit in the large national firms. Why is that? Because they're paying so much for these firms. They're paying cash. And nowhere in there is we're going to spend millions of dollars sourcing organic leads, and there's not economic incentive. I will exclude Ken Fisher, because Fisher spends a fortune, but they have not traditionally been an acquisition firm. We'll see if that changes now that they've raised money. They are truly the only truly national singular experience. Everyone's an employee. Advisor leaves, it's unlikely they take their assets because everything's managed centrally. And so I view them as the only truly integrated national firm. And again, I don't want to point fingers at anyone, because I know Ken well. I know a lot of the other folks who are leaders of the other firms. But they're being, other than Fisher, almost all of them are run and controlled by private equity firms. And that, as I've written before, misaligns interests, because their only goal they have is to increase equity value and get to the next 3 to 5 years from now, get to the next trade, take off my position, bring in somebody else in. Again, that's their goal. Their goal is to maximize as fiduciaries the equity return. It's not to build a great culture. It's not to have organic growth, although that's helpful. And so they're not building things that are built to last. They're built to get to the next transaction. And that can be very misaligned with young advisors in their early 40s who say, hey, I'm not getting enough upside and I can maintain my upside by myself. And then
they're not incented to grow, and they're trying to maintain the book of the retiring advisor. Right. I've always had empathy for that G2 advisor who they have a lot on their shoulders and little time to grow and no programs to latch on to grow.
And then lastly, the bureaucracy at these larger firms is significantly greater. Like you're seeing multiple layers of compliance and oversight and reporting and centralization that forces clients to move over, even if there are bad tax consequences for them. So they have to do this. Again, the risk is much greater when you're at 200 billion. The regulators view you in a different way than when you're at 3 billion or 4 billion or 5 billion. We're held to the same rules, but the standards are just high. And I experienced that firsthand.
And they're going to come in and take a look under the hood. They can't cover all of the firms, so they're going to look at the rapid growers.
And so you end up with a situation where you're like, okay, is this the time? And is this the place? And I've talked again in prior articles about what you need to think about, but I do think that's an important question.
If someone's watching who is, say, a 30-something, 40-something, rapidly growing advisor or boutique firm, what should they be looking for?
Well, the first one is control versus lack of control. Do you want to be in the cockpit, or do you want to be a passenger on the back of the plane?
Mhm.
And the truth is, you join a mega firm, the likelihood is you're sitting in the back of the plane up to the whims and fancies of whoever's in the cockpit. Now, they might be great and it might be going
Mhm.
somewhere you'd rather go. But the first and most important fundamental question is, where do I have discretion and control and a voice in the direction of this flight? Because
Mhm.
a lot of folks, again, at United Capital, they were on our advisory council. They decided what we were going to invest in, what
Mhm.
client experiences we need to improve. And the most important question is, are my clients better off because of this transaction? Is my business better off? Are my employees better off? So, so that means, like, how much flexibility and control do I get to say in what happens? Because again, if the goal is to bring them all in and just move clients over to an experience that might not be better than what you're delivering today, if the underlying business is not better as part of this
Mhm.
larger firm, then it is an economic transaction and somebody has to lose. It is a fixed pie. If the pie gets bigger, everybody wins. And I've always believed the fundamental first question should be, are my employees better off? Am I better off? Are my clients better off if I
Mhm.
join this? Because if that's true, then the pie is bigger. And if the pie is bigger, the slice can be smaller, but everybody wins. And that question doesn't matter. The second, how much autonomy do you have? We talked about this. How much control do you have? Do you have to get a
Yeah.
voice in budgeting? Do you have a marketing allocation? Very often you join a mega firm, here's what you can spend and nothing more. Anything else you
Mhm.
need to get approval. Heck, there's some minority investors that put all kinds of controls in their investment as well. So the truth is, advisors by their nature like to be kings of their domains or queens of their domains.
Mhm.
And not everybody wants to be part of a franchise of an entire thing. And the difference is, do you run your own firm or do you run a franchise? And does the franchise bring value to your enterprise? And not everybody, there's an advisor suited to being part of a franchise. And if they're wanting a big check, then yes, just go get the biggest check you can. Make sure it's the nicest home you can find for your clients. But if you're looking to stick around, there are three things that matter. Number one, you and your clients, your employees have to be at least as happy, if not happier, in the new world. Number two, your growth prospects for you, your clients, your employees have to be at least as good in the new world. And third, economically, you have to be better off in the new world. Those three things must be true. And if they're not true, then you'll put excess pressure on the other two and you still won't get a transaction done. So, having done well over 100 transactions in my life, I know that those three things really matter. And the
Yeah.
last, and the growth, which is that second thing I mentioned, are you going to grow faster? What kind of investment is being made to help you to grow, and how much of the economics do you get to keep as a partner? And that's something, again, we've made two portfolio investments. We spend hours and hours with them thinking about that question. How do we make sure that the economics align? Because every firm we invest in, our goal is to quintuple them in size over the next 3 to 5 years with quality and being additive to every advisor that joins. So that requires a level of thinking that many entrepreneurs don't take the step back and say, okay, if I'm selling, how does my growth prospect look? What are changes that allows me to be more successful and allow me to share that with my G2 so that they make more money? So again, I think it's a big question whether you're selling to get out or planning to continuing to build. And I would suggest if you're planning to continue to build, the partner you choose really matters.
Absolutely. Well, as always, really good tips, Joe. At the end, you started talking about organic growth, which got me thinking about some of the brand work we're partnering with Bleakley on and organic growth programs. So maybe the next few of these we should talk
Yeah,
about
we should
growth.
talk about that. And, honestly, our industry is in a very important threshold point here. Other than the sale of United Capital, there has been no major transaction that is not a sponsor to sponsor transaction. And nothing has happened in the public markets other than the reverse. Companies
Hmm.
that were public going private. Until we know that there's an exit point and what that looks like, it doesn't really matter that these firms are good or not good. But there is a big difference between a Fisher and another RIA that maybe is doing a bunch of acquisitions but not integrated. And there's going to be discernment. Today, there's so much money coming in that nobody seems to know or care about the difference. But quality does matter. And the public markets are very quick to
Hmm.
flush out what is our value and what is not. And the challenge is, it's more than just growth. It matters what your same store sales growth are. It matters
Absolutely.
what your average age of your clients are. It matters what the average age of your advisors, and that they're equitized and participating in the growth. So these are all nuanced things that matter, whether you're
It'll
a
be
buyer
fun
or a
to
seller.
see where it goes, won't it?
It will be very interesting. There will be winners
Yeah.
and there will be losers. So it's
Absolutely.
all an amazing voyage. We have an incredible industry and it keeps on evolving. And this is just part of the maturing phase of the industry as we go from a fairly nascent business and everyone starts to jumble toward the same thing. I think it's really fascinating.
I agree. So we'll be back to talk about it some more. Great to be here with you, and we'll see everyone next time.
Thank you, Jen.
You are listening to Rise Up with Rise Growth Partners. If we helped you to rise up today, please subscribe to the show so you don't miss future episodes. Leave us a review to tell us what you loved, what topics you'd like to hear, and please share it with others in the industry. After all, we're here to